Food prices are up, housing costs too. But what about fuel and gas prices? Yes, those two. With us now to explain in Calgary, Alberta, Max Fawcett, columnist for the National Observer and former editor of Alberta Oil Magazine. Hi, Max. It's really nice to meet you.
Nice to meet you too.
To get into our conversation, I wanted to show you a clip of the last time that you were on the show last year in April. Sheldon, please roll.
I'm definitely in the school of thought because this is a school that has had many lessons where the lower the price of oil goes, the higher it goes down the road. You know, the cure to low oil prices is low oil prices, and we have never seen prices this low. So I do think, you know, anyone who's writing off the oil and gas industry, who's saying, "Oh, well, this is the end of it," I do think we could see $100 per barrel of oil by 2023, 2024, and it could last for a couple years there.
You know, you kind of made that call a year and a half ago. It seems crazy that April of 2020, we thought this wouldn't be around for very long. But you were correct in part of what you were saying there. How significantly have things changed in the energy sector since then?
I mean, on some level, it is the most profound change that I've seen in my lifetime, and not just because of what happened during the pandemic, but we are looking at an industry that is in the middle of a transition, and I think a lot of people expected that would mean lower prices, that it would mean, you know, oil prices collapsing, and what's actually happening is, as we're seeing in markets right now, it's kind of the reverse. The cure to low oil prices, like I said, is low oil prices, and so what companies have done is they've stopped drilling, they've stopped investing in new projects. You know, we're not seeing any new oil sands mines being built here in Alberta. And that's now starting to show up in the market. There just isn't the kind of supplies that are needed to meet recovering demand. We're not quite at the pre-pandemic levels of oil demand globally, but I know most major forecasters expect us to get there by 2022. So my call may have been a little conservative. We may see $100 oil next year. And I'm not sure that that's going to change in the sense that, you know, in the past, high oil prices and frankly, even not so high oil prices encouraged companies to drill. You saw that in Texas. You saw it here in Alberta. It was sort of the drill, baby, drill mentality. Now, because of concerns about climate change, climate policy, the energy transition, these companies simply aren't investing. They're giving their money back to shareholders. They're being told by their investors not to drill, to give it back in the form of dividends and buybacks. And so we're not going to see a supply response. We're not going to see a surge of new supplies from North America. And that could mean prices stay high for the foreseeable future.
Well, that was my next question, but I want to go back to something that you said at the beginning of your answer. You've been covering this industry for a very long time, and you called what you're seeing right now profound change. What did you mean by that?
Well, for a long time, it's been environmental activists, climate activists who have been telling the oil and gas industry it needs to change. And the oil and gas industry didn't really listen to them, to its discredit. But now it's the major players on Bay Street, on Wall Street, in London, the biggest pension funds in the world, the biggest institutional investors. They're all saying that these companies have to change, and if they don't change, they're going to pull their money out. We saw that, with Quebec's pension fund manager, the Case, which says it's going to pull out of all oil and gas stocks in the near future. So, you know, it's that version of the golden rule. The people with the gold make the rules, and they're changing the rules really fast right now. And now you're seeing the companies respond because, you know, maybe they could have ignored environmental activists. They can't ignore the people that invest in their companies and fund their operations.
Well, you mentioned that the prices are probably going to continue climbing in North America. In the UK, I know you've seen that footage of what's happening in the UK where people are lining up to get gas. What's going on there?
It's yet another piece of the Brexit hangover. It turns out that if you are trying to chart a bold independent path, as Brexit supporters have argued, and conservatives here in Canada have cheered them on for, you're a little more exposed to things happening in the world. And what's happened with COVID is there's a huge labor shortage. It's just harder to get people to do the jobs that they used to do for not a whole lot of money. And so one of those jobs is people driving trucks with fuel in them. And all the dislocations with COVID and and what's happening in supply chains around the world is kind of showing up at gas stations in the UK. And I know I think they're on their way to a fix there. They've got it sorted out. But that is sort of an example of what happens when you try to go it alone. Is sometimes you really are alone.
Well, you mentioned supply chains. I saw footage of people with the canisters, the jerry cans that you see back home for me in Africa, people hoarding fuel. Is that something that you see, that you're worried about happening here?
I'm not. We're a much more interconnected energy market than the United Kingdom is. We're close to supplies. We're close to refineries. We have a lot more slack in the system that can pick up when things go sideways. The caveat to that is Line 5, and I'm probably eating one of your questions that you wanted to ask me, but Line 5 is the wild card here, because that supplies a lot of the material, the gasoline, the food for the refineries that helps fill gas stations in Ontario and Quebec. And I don't think that that's going to get shut down, but I'm not sure. I don't think I can say for sure that it won't. And if we've learned anything over the last 18 months, I think it's to not discount the improbable, because we've been seeing a whole lot of improbable lately.
Well, you mentioned Line 5, and last year, the governor of Michigan ordered Line 5 to be shut down. The talks are going on between the U.S. and Canada, but are you worried that that dispute might affect the cost of fuel?
I think the political price would be so high in Ontario, and so it would be paid so dearly, that our politicians are on top of this in a way that they might not be for other issues. Let's say, I know that frustrates people in Alberta, that the federal government seems more responsive to pipeline issues affecting Ontario than Alberta. But hey, that's politics, I'm afraid. I don't think that it will be a long-term thing. I think if there was any sort of suspension of the pipeline, it would be a matter of days, and that our existing supply chains and supply networks would find a way to work around it. You might see a little bit of an increase in fuel prices, but certainly nothing permanent, nothing that people really need to get worried about. The bigger worry is just that high oil prices are here probably to stay for the near term, and so maybe you won't be paying $2 a liter in Toronto, but you're probably not going to be paying $1 anytime soon.
And I don't think anybody can forget the images we saw earlier this year of Texas. Texas was covered in snow. We saw images of homes being flooded because of the extreme cold. Are you worried extreme weather events would affect supply like what happened in Texas?
I'm not, just because we're a little better at dealing with cold weather here in Canada than they are down there in Texas. Our assets, our infrastructure is winterized. We're minus 40 is not an unusual thing in Alberta, and so we're well prepared to deal with it. I do think the bigger issue is that natural gas prices around the world are going to levels we haven't seen in over a decade. In the United States, I think natural gas was above $6 the other day, which is a level we haven't seen basically since the late 2000 and before 2010. So the risk to homeowners, the risk to ratepayers is not having access to natural gas or electricity. The risk is that they're going to pay much higher prices than they're used to paying. I think a lot of people are going to open their power bills this winter and be a little shocked at what they see in there, especially in markets like Alberta, where they depend on natural gas really heavily for their electricity and heating needs.
So you're saying this is something that consumers should just get used to. We're going to be paying more and more.
We're going to be paying more in the near term, certainly. I'm not sure that this will last. It's certainly not going to last forever. It may not last much more than a couple of years. We are seeing massive investments in renewables, low-cost renewables, and that is the way of the future. That is where the global economy is going. And in the long term, that will mean lower prices. I know this is a popular talking point among conservatives, where they want to blame the carbon tax for rising power prices and rising fuel prices, but it's really not. People in Ontario get a rebate. People in Alberta get a rebate. This is the market reflecting market fundamentals, and over the long term, that market is changing, and the market fundamentals for renewables, thankfully, are much better from the perspective of the consumer. So, there may be some short-term pain here, but we will see the gain in the years to come.
I think we just scratched the surface of this. We'll be having this conversation again, I'm sure. Max, thank you so much for your time and for your insights. We do appreciate it.
Thanks for having me on. Happy to do it.
The Agenda with Steve Paikin is made possible through generous philanthropic contributions from viewers like you. Thank you for supporting TVO's journalism.